Hello and welcome to a very special edition of the Defiant Weekly. It is Friday, the 21st of May, 2021. And it has been some week, a red week, shark week, if you like. And normally what I would do for the Defiant Weekly is I would plan a whole bunch of stunts and gags and comic things and research a whole story and do a whole bunch of things, but we just haven't had time this week. We were delivering the big Terry Crews viral, which you haven't seen. You can find it up here. But it was a big week in crypto and a big week in DeFi, mainly because we just saw red candles, like big red candles for the first time in quite some time. And the thing is, if you've been in this space as long as I have now, which is not that long, but it's since 2017, we experienced the long bear, the dark night of the soul, if you like. And it's been quite nice not to be looking at red candles but at green candles. So when we saw the red candles this week, it felt familiar and it felt weird, but it also didn't feel that scary because we've seen the worst of it. I've seen Bitcoin go from 20 grand down to 3 grand. And this, you know what? There's this crypto shrug that happens. You just go, we can learn a lot from our French friends. That is just how you deal with adversity. So rather than plan a whole bunch of things, I've just printed out a bunch of the stories that made sense to me this week, the things that were feeding into the broader narrative. What are the stories that are driving the market? And I'm not going to do technical analysis, and I'm not going to do big financial analysis. I'm going to do what I do best, which is narrative analysis. Because as we know, crypto is driven by memes. It's driven by storytelling. That person who tells you something in an anonymous Telegram group that then becomes a whisper, becomes a rumor, that becomes a thing that drives a pump. That is how crypto works. And it's how this whole space is driven by narratives that take flight and they crash the market and they pump the market up. And that is a world that I'm incredibly comfortable and familiar with. So what I've done is taken a bunch of these stories to try and make sense of what is actually happening and what happened this week and why we shouldn't be that scared about it. Because if you're scared and you felt the pain, that deep, sickening lurch in the gut this week, I don't blame you, because that is horrible. But first, let me take a sip of my cold, refreshing drink of a non-disclosed brand. Yummy. Let's get into it. So, damn it. I always forget this. We have some sponsors. Let's see the sponsors' messages. So, firstly, don't let high gas costs keep you out of Ethereum. At Balancer, you can trade all you want and get most of the gas costs back in your pocket. In their new BAL for Gas campaign, traders are now receiving 6 figures worth of BAL tokens every week, and with version 2, Balancer is becoming the one-stop shop for DeFi liquidity. Balancer version 2 is bringing stable pools and weighted pools tightly integrated under a single protocol with flash loans, lending via asset managers, and much, much more. Balancer version 2 is awesome. Check it out at balancer.finance. Now, do you remember your first DeFi transaction? After juggling maybe 5 tabs on your browser, you gaze at that Etherscan confirmation, feeling like you just contributed to the future of finance. Except you got quickly lost. I know I did. In a world of gas prices, vaults, pools, farms, hard forks, degenerates, and sushi chefs. Now, fortunately, Zerion has built the dream tool for managing your portfolio. You can track all your token balances across wallets and chains, access every kind of DeFi asset, including indexes, pools, and yield strategies, and trade at the cheapest rates with no extra fees. And that is because Zerion sources liquidity from every decentralized exchange, every single one, like Uniswap, 0x, and 1edge. There's no sign-up required, no fees, and a blissfully easy user experience. Simply connect your wallet at app.zerion.io. Final sponsor today is Aava. If you did not know already, and you should do if you watch the videos on this channel, the name Aava is taken from the Finnish word for ghost. I don't know why they called it ghost, they just did, but it has a cute little icon as their logo, and it is a decentralized, open source, and non-custodial liquidity protocol on Ethereum. If you're a depositor, you can earn interest by providing liquidity to lending pools, while borrowers on the other side can obtain loans while tapping into these pools with variable and stable interest rate options. Deposit into the Aava protocol and receive A tokens, which accrue interest every second right in your wallet. But that's kind of wild. I'm actually looking at charged particles right now where we can put Aava tokens into NFTs. Cool stuff. So you can basically watch your balance go up every single second, earning yield. It's good. Swap any of your deposited assets at any time to get the best yields on the market. And for the devs out there, Aava features access to DeFi building blocks like flash loans and credit delegation. The Aava protocol liquidity pools are now available on Ethereum and on the chain of the day, Polygon. Okay, so that is sponsors done. Let's get back on with the show. First thing I noticed, of course, was Bitcoin dropping to 30K. We've been pushing up. And as we know in markets, what goes up generally comes down. What was interesting for DeFi heads, Ethereum dropping to 2K, and it dropped 40% in less than 24 hours. And we consider Ethereum a blue chip coin now. I wouldn't call it a stock, but it sort of has that same veneer around it. Invest in Ethereum and it's safe. And from a personal point of view, I look at Ethereum now as just money. It's just transactional currency. I use it to buy things. I don't really even think of it as an investment anymore. But for many people, it was. Now, what was driving this massive downturn in the market? Well, there was a few different things, and it was a confluence of all of these different ideas and these different narratives at the same time. One of the more interesting ones was JP Morgan's report saying that institutions were now moving away from Bitcoin as part of this hedge against inflation and moving back to gold. Now, why would they be doing that? Well, it's quite possible that when Bitcoin goes up as much as it does, it becomes less attractive as an investment, and maybe gold looked more attractive because it hadn't seen such a broad increase in price, and Bitcoin just looked overpriced. Quite possible. Tech stocks were also struggling this week. There were reports of 5% drops in some tech stocks. It doesn't sound like much in terms of crypto, where we see, like for instance, 40% on Ethereum in a day, but still, that is quite a lot. And the upshot of all of this was cascading liquidation. So we had positions being liquidated in the market, causing stop losses to get triggered, causing more stop losses to get triggered, and then very quickly what happens is just the trapdoor opens underneath you and off you go. Now, Sam Trabucco, who, if you don't know, is part of the same team as Sam Alameda. They are very, very, very strong market traders. He's written an amazing thread, sort of giving his take on what went on here. And he was sort of debunking the idea that institutions were buying spot and were holding physical Bitcoin, and that was the reason the market was going up. He identified the idea that the leveraged positions in the market were what had caused the cascading liquidations. And that was basically borne out by the research that he'd done. But he also said that that represented a fantastic opportunity to buy and get back into the market, which is exactly what he did. And, well, I hope he's making lots of money off that, because they're people that many in the market look to for information and advice. Now, it's been a while since we saw China FUD, but China FUD was back. 2017, 2018, China FUD was a big deal. If you were an investor in NEO, for instance, back in 2017, you would have had an amazing time. Ant shares, then NEO, boom, whack. NEO got killed by China FUD. And this idea that China is banning Bitcoin, this narrative that China is banning Bitcoin, just keeps coming back again and again and again and again and again. And there's this idea that it's sort of run out of steam and that it doesn't have any power in the market again, but clearly it does. So what was the deal here? So China is banning crypto-related investment products in financial and payment institutions. They've done it before, they'll do it again. Looking through the ashes today and on Thursday, it turned out that it wasn't quite as severe as might have been expected. And it was also we know that there's a lot of mining power concentrated in China. It didn't appear to have affected anything. I think by this point, we've had so many instances of China FUD that people are like, whatever. So that was another thing. Obviously, Elon played a big part in all of this. And Elon's been kind of the poster child for crypto, and in particular Bitcoin. What he did primarily was say, you can buy a Tesla with Bitcoin. I ask you, how many people in the world own Teslas, and how many of you are actually the proud owner of a Tesla? It's a very niche market, but it's this sort of totem for, market sentiment the broader institutions coming in. We have Michael Saylor, of course, as well. Michael Saylor doubled down during the dip. He put $10 million or so back into Bitcoin when the market dropped. So that was interesting. Elon also came out today and said he hadn't sold any Bitcoin owned by Tesla. The environmental concerns that he flagged were around mining in particular. And as we know, the quantifiable data around the environmental impact of mining is quite hard to put together. And it's quite hard to get a really good sense of what that environmental impact actually is. And there is more and more evidence to suggest that solar power, renewable power, and renewable energy is starting to power Bitcoin anyway. And as we know, Bitcoin is one network. It's the most valuable network, yes, but there's so much more to crypto than that. I know, for instance, that Near Protocol has a carbon neutral directive within the organization to try and minimize the impact environmentally of what they're doing. But that's just one network. You can pick and choose the network that you want to work on or work with or invest in based on their environmental impact. We have a choice. It's not the be-all and end-all of crypto. And obviously, the Doge heads, the doggies out there, they were all very excited about Elon being a fan of Dogecoin. Who knows why that is? Maybe he's just trolling us. Maybe he's just having fun. But that has played a big part in all of this. But if we take a look at the news, Dogecoin jumps after a series of Elon Musk tweets, fans more wild cryptocurrency chain. Yes, I did a terrible job of reading that headline, but on Thursday, Elon was back saying, and if I can find the tweet here, I haven't and I won't sell any Doge. So Elon hasn't sold any. Was Elon short? That's the big question. Who knows? Now, one of the other really big interesting stories that came out yesterday was Wells Fargo, which plans to add an actively managed crypto product. So Wells Fargo, big bank. One of the fun things about Wells Fargo is if you investigate them and look into what they have done historically over the years, I can't think of another bank, maybe HSBC, that has had so many fines for just screwing customers. It's extraordinary. But now they're planning to add an actively managed crypto product, but it is for wealthy investors. Good for them. You know, this sort of feeds into the idea of cognitive dissonance. Refreshing drink. It feels like the market's crashing and burning, and yet, at every single touch point, you see all these positive signs. The market is stronger, the sentiment is stronger, institutions are here. And I guess what was driving all of this was the sense that it had gone up so much, at some point it had to pop. And back in 2017, it was about ICOs. It was about this access to new liquid capital that was driving innovation and was creating money out of thin air, effectively. This time around, it's been about institutions. The institutions are here. I seem to remember back in 2017, we were talking about institutional investors coming in, and they weren't in yet, but once they did, and it could be through ETFs, it could be through all sorts of other things, the market would take off. That has been the prevailing narrative this year and at the back end of last year, that institutions were coming in. And so when you have someone as prominent as Elon saying, yeah, I'm not sure about Bitcoin environmentally, it does have a major impact on at least some of the market. But was that all that was going on here? I'm not sure. Let's take a look at DeFi. DeFi, if I remember correctly, had pushed up towards $80 billion in TVL, total value locked. And it's currently sitting at 64.67%, $64.67 billion in TVL. That's still a lot. You know, dropping from 80 billion down to 64 billion, that's a big drop. But even so, the state of the market, the health of the market is still intact. And it does remind me of a period back in 2017, I believe it was late May, when the whole market dropped about 50%. And it felt horrible. I remember over the course of a weekend watching my entire portfolio drop in value by 50%. And I remember talking to my friends and laughing about it because we just couldn't believe what we were seeing. We had, I guess, talked ourselves around to the position that we were smart. and that we'd invested in something that was going up in value and that was amazing. And then suddenly it just... But what was really extraordinary was how quickly it recovered. And that we were in this period where Bitcoin just kept going up, kept going up, kept going up. And you couldn't believe every single day that it could keep going up the way it had. And then suddenly it dropped. We recovered all of that, and now look where we are now. If you look back at 2017, all of those little things look tiny. So DeFi's big test this week was, could it withstand the drop like this? And we have to go back to the MakerDAO Black Thursday incident where there were a ton of liquidations and Maker just could not handle it. And I forget the exact numbers, but there was a significant amount of Ethereum that was just gone because the oracles were too slow. It was difficult for the prices to be matched properly. And basically, yeah, the whole system didn't work as it should. But if I look at this most recent article from the Defiant, Owen's quite rightly saying that even despite the stress that was in the market, like the DeFi Pulse Index basket of DeFi tokens dropped over 20% in an hour and more than 40% overall. DeFi protocols never stopped running and generally behaved as designed. This whole week was a kind of stress test for DeFi. And in general, it worked pretty damn well. Now, DeFi protocols liquidated over $700 million this week. But that's the thing, if you take out a loan and you are at risk of being liquidated, then the onus is on you, the borrower, to manage your position, to protect where you are at. So if you get liquidated, that's on you. Now, we've spoken extensively on the channel about ways of mitigating this, of taking positions which cannot be liquidated, or using something like Alchemix where the loan pays itself off over time. So you don't have to expose yourself to that kind of risk. But yeah, there's some absolutely astonishing figures here. What's interesting, though, is that centralized exchanges that were offering crypto futures liquidated almost $7.6 billion worth of positions. And if you were trying to do anything on Wednesday, I think it was almost impossible. The whole system just broke. And there's this meme about Coinbase that whenever the market turns red, you cannot operate on Coinbase. You can't withdraw funds. It just completely shuts down. There's gridlock because it cannot handle the system. And it's that panic flight to safety is something that Coinbase possibly can't sustain. DeFi protocols, generally, didn't happen. So all of those lessons from Black Thursday seem to have been learned. If we look at the stablecoins, now stablecoins are supposed to be pegged to $1. That's the whole point of a stablecoin. What happened? Did they manage to maintain their peg? Well, no. So Tether, which is the number one stablecoin, it went actually all the way up to $1.08 and then settled back down. What happened to USDC? Well, that went down to 89 cents. So there was a huge buying opportunity there on USDC. BUSD 90 cents, DAI 93 cents, and UST 86 cents. That's interesting. That's very interesting because UST is the native stablecoin of Terra. And as you probably know by now, I am always keeping an eye on the Terra ecosystem, Anchor, Mirror, Terra itself. So what happened to Anchor, which promises a 20% fixed rate of interest on UST this week? Well, I don't need a piece of paper in front of me because I keep an eye on it every day. The fixed rate is supposed to be set at 20%. It dropped down to 18%. I think it might have even dropped into the 17%. So lenders would have seen a 2% decrease in their APY this week, which was a savage week by any stretch. So that's 2%. So they're still getting an 18% interest rate. On the borrowing side, however, the borrow APR was up above 100%. So this is basically the protocol saying, we're going to incentivize you to borrow, to inject liquidity back into the protocol to bring the interest rate on the lending side back up to 20%. Which means that it's incredibly favorable to borrow right now on Anchor. And that's extraordinary. I'm still wiring my head to think about borrowing as an aggressive, positive position in the market. And I think if you take the borrowing side right now, you could see some significant gains. Now, you don't get paid in UST, you get paid in ANC. But that was a really interesting case in which the Anchor protocol was stress tested under significant load, and the drop on the saving side, on the earning side, was only 2%. So it's still a great interest rate, even under that kind of load. Really fascinating stuff, but not as fascinating as the final story I'm going to cover today, which is the story of Justin's son and how he almost caused Ethereum to drop below $1,500. Now, this story starts on 4chan. And this is amazing stuff. So 4chan, if you don't know, is a message board where, anonymous people post stuff, and generally it's where conspiracy theorists go to find information about whatever might be happening in the market. It's where a huge amount of chain-link Marines were born, and I'm sure it's where a bunch of other stuff was born. But it's generally where you will find like the most kind of suspicious but possibly best intel. I tend to stay off it these days. But anonymous posts, hey guys, insider here. For those of you that are not busy Mumo Bobo LARPing and paying attention, there will be another announcement from China soon. Now this is posted on the 18th. The picture is semi-related. I can't tell you guys what firm I work for, but it's massive and it's working with the PRC. The purpose of today's press release alongside all the FUD posting is to get BTC as low as it can get before 7 a.m. UCT. First, there'll be a coordinated sell-off to drop the prices below a certain threshold and liquidate one certain stakeholder. I can't outright say who he is, but he bought a lot at the dip that he was partly responsible for. Once liquidated, the plan is then to buy up all the reserves and essentially leave him bankrupted. The thread then goes on and starts giving kind of timelines. It says, this is going to be big and fast, 35K limit order if you want to be safe, but you can probably go as low as 31.25K. Expect 30K, that's a guarantee. So this person was making a prediction about the Bitcoin drop. Bitcoin dropped to 30K. Interesting. The poster also goes on to say, NASDAQ will take a slight hit in the pre-market. It will most likely drop a point by the time the market closes. The bull run's all-time high tops out well above 100K. Do not trust the FUDs. The movement is just a silly game that the elites are playing. So who was this mysterious person that they were planning on liquidating and leaving bankrupt? Who was it? Well, there are not a large number of people that this could be, and there are not a large number of people that you would want to do this to. But it quickly became apparent who it was. It was Justin's son. So Justin, basically, according to what we can find out, had a $1 billion position on Liquidity Protocol, and it could have been liquidated. So you imagine $1 billion gone. So I found this tweet from Philip Castonguay. Said there was about a 2-minute window where Liquidity Protocol went into recovery mode and Justin's son's $1 billion position could have been liquidated, but it didn't happen. He just rebalanced his trade 5 minutes ago, paying $300 million back worth of debt. Oh my gosh. Oh my gosh. $300 million worth of debt. So he was in a position where that default on that loan could have just killed Ethereum, but it didn't happen. So a report by Wu Blockchain claims that he had a 606,000 ETH position, which was almost liquidated, and if it had been, it would have caused ETH to crash to below $1,500 or $1,000. Now, seeing ETH pushing sort of towards $4,000 feels just weird to me, because for so long, I've been used to seeing it around, $300 to $400. But that would have been significant. It didn't happen, though. And what did happen is that Justin actually took advantage of the drop, and he posted the fact that he had bought 4,145 BTC at an average price of $36,868 for an estimated $152 million. He says, I bought many on a dip today. This is only my BTC purchase. Keep biddling by the dip. And so panic stations averted, everything is fine. Brilliant. There's another quote here from Wu Blockchain on their tweet, and they said, Justin Sun said in a Chinese community, like a bullet passing through the scalp, I saved the cryptocurrency. I mean, this looks to me very much like a messiah complex, Justin saving Ethereum, Justin single-handedly saving Ethereum. Make of that what you will. Now, the takeout of all of this is crypto is much more resilient than we give it any credit for. Weeks like this do happen. It happened many times back in 2017. It's happened again. And if there's one thing I can teach you, it's just perfect your shrug. Whatever you need to protect yourself from the mental pressure of all of this, whether it's just to not look at your phone, to go and do something else, I don't know. But this happens all the time. It's part of the world of being in a stressful, volatile market like this. But I would urge you to look at the positives that have come out of all of this. Firstly, DeFi demonstrated resilience, and it will demonstrate even more resilience the further we go into this. There is no doubt that figuring out downside protection, hedging positions, understanding how to hedge yourself properly, and using different protocols for the strengths that they have in terms of being liquidated or not being liquidated, you have options there. Elon Musk didn't sell anything. In fact, he wrote a tweet saying, yeah, Bitcoin might be bad for the environment, and therefore, from Tesla's point of view, as a company that's looking to be environmentally friendly, this doesn't make sense. That's not really that shocking. Anchor Protocol retained an 18% interest rate on savings despite the drop. It didn't just suddenly collapse to 1 or 2%. It was pretty resilient, and the borrow side incentives will bring it back up. And there have been tons more interesting stories this year. The rise of DAOs, for instance, the rise of the power of DAOs, and the power of people to come together and self-organize and do something incredible. From a personal point of view, it all feels incredibly positive. I would urge you to just, if you're worried about all of this, don't look at the narratives on their own. Look at the broader picture and take another view, because, you know, there are so many positive things to talk about here. Inevitably, this cycle tops out. It will end at some point. I don't think personally that we're there yet, but always have a backup plan. Always think about what happens when this happens, when we have a red week. Am I in a position to buy? Have I made whatever gains that you have safe? And I would be investing in other things, like relationships, like networking, like the things that aren't necessarily tied to the market. From a personal point of view, I invested in this space, in the Defiant, in what we're building here. And that means that whatever's happened here, I have something that's not tied to the market, and that feels pretty good. It wasn't always the case. Back in 2017, I was a total noob, and I was trading wallet to wallet. I'll give you an example. I bought some clams. Don't know why I bought clams, and I downloaded them to the wallet. The clams wallet took 10 days to sync. So for 10 days, I didn't even know if the clams were even in my wallet. That's how much of a noob I was. And now, look. So that was the Defiant Weekly. These were all the stories that came up. There's still $64.67 billion locked in DeFi. I hope you have a wonderful weekend. Don't panic. Grab a drink. I'll see you on the next one.